Welcome back. This morning, the consumer price index was reported. CPI month over month 0.2% versus the prior, no change. Core CPI, excluding food and energy, unchanged. CPI year over year up 3.2 versus the prior 3%. The core CPI, excluding food and energy, 4.7 versus 4.8. So CPI goes up, inflation goes up, and that's the first tick up in quite a while. Core CPI, excluding food and energy, goes down. It means food and energy are the upward pressures. And we're going to see in a moment what this means in terms of the likelihood of another Federal Reserve interest rate hike. First, we see here yellow line CPI. These are year over year lines. That has ticked up for the first time in quite a while, probably almost a year, it looks like. The core CPI, excluding food and energy, is going down. So prices are going down if you take out food and energy. But again, food and energy represent very important components of our economy and our day-to-day lives. This is a CPI in purple. That's year over year again. The red is core CPI. We break down food in yellow, or I should say in orange, and yellow is energy. Now we see a tick up in energy prices. Maybe that's due to the summer seasonality effect, but nevertheless, energy prices are rising, and that looks like that is really attributed towards our tick up in overall inflation. We see here CPI food. Actually, it's declining. It's really the energy prices that are moving higher. Now we see year over year CPI versus the S&P 500, a very strong correlation. You know, they both hit those very significant lows in April of 2020. That was that COVID stock market crash. Now we topped out on the stock market late 21, early 22. Same thing for CPI a little bit earlier than that, actually a little bit later than that. But we've seen the stock market has resumed, and this really is a very interesting situation where stocks cannot seem to find an end to this rally. It's good if we own stocks, but given that, we see a lot of indicators that are moving to the contrary. Now, I know you may say, well, oh, CPI is going down, except for today's report. Overall, it's going down. That's good for stocks. Well, yeah, in a sense, it is. It's good for consumers. It's good for us. Things are cheaper. We can buy more. Companies report better earnings. You know, that certainly is the case. But generally speaking, inflation moves in the same direction as the economy and the same direction as stocks, meaning that inflation exists. And it's getting into a little bit of the weeds, you know, as far as fundamental analysis is concerned. But inflation typically exists when it's the result of GDP growth. You know, we make more money, we spend more money, we buy a bigger house, a bigger car, and, you know, better stuff. Prices rise, more demand versus supply. That's healthy inflation. What we're looking at right now is Federal Reserve manufactured inflation, where the Federal Reserve printed a ton of money and created a lot of different programs to help us out of the COVID stock market crash and the economic turmoil. Certainly, hotels, airlines, a lot of different industries, restaurants also really got hurt during the COVID situation. So, you know, you inject all that extra cash into the economy, and that also creates inflation. It's not inflation that was caused from economic growth. It was inflation caused by the money supply exploding, you know, that we've talked about in the M2. We see here the federal funds rate is in blue, the CPI ticking up for the first time today in a while in white. Now, here's the question. And if you think about it this way, we have a 2% target on the federal funds. The Federal Reserve has a 2% target. They want CPI at 2%. They're going to continue raising interest rates until we hit 2%. Now, the white line we can see on the right-hand side has ticked down. We're at the 3.1% level, roughly, actually a little bit higher, 3.2% level. We want to see it down to the 2% level. The federal funds rate is above 5%, 5.5%. So, with that said, the question is when we went above 2% on the white line, this goes back to early 21, the Federal Reserve, the question is, Should they have started raising rates sooner? When we saw CPI go up to 5%, September of 21, should they still have kept rates so low here? When we saw CPI at 7% year over year, should they have started to raise rates earlier? This represents nearly zero interest rates plus a lot of money printing. Well, I thought the Federal Reserve had a 2% target. We cross above that line here. Now, maybe, we want to give them the benefit of the doubt. They wanted to see if this was really going to unfold. You don't want to raise interest rates in the middle of a COVID recovery. But we see here, because they raised rates, or they kept rates so low, so long while CPI exploded, now they're forced to raise rates. Is this a delayed reaction? See the top on CPI and the top on the federal funds. Well, what happens next? Well, we're going to introduce a new segment that we hope will be very helpful called the Fed Watch. The red line, and we've mentioned this before, but we added something very fun to this. The red line represents the probability that the Federal Reserve will keep interest rates where they are right now, 5.25 to 5.5. The blue line represents the probability the Federal Reserve will raise interest rates from 5.5 to 5.50, 5.75. Right now we're at the 5.25 to 5.50. Now we can see at the bottom, this is our timeline, and what we've added, which we think is a lot of fun here, are some significant economic events, not all of them, of course, but we will add over time, the significant economic events which go to influence the Federal Reserve and maybe will change their decision. Now, this is calculated by the federal funds futures contracts. And for example, you see when construction spending was released early August, August 1st, I believe, with an 82% probability Federal Reserve will not raise interest rates and will keep it at 80 at a 5.25, 5.5. There was an 18% chance they would raise interest rates from 5 to 5.50, 5.75. That's 5.5 to 5.75. Well, you can see this probability pretty much held steady until we saw non-farm payrolls about a week ago, last Friday. 82% went up to 87%. Remember, the non-farm payroll number was a little bit soft. The Federal Reserve has a dual mandate. They got to keep inflation under control, but they also have to not destroy the job markets. Well, jobs market weakened a little bit, and so that tells us that it told the Federal Reserve, hey, take it easy. Maybe consider not raising interest rates. The jobs numbers are starting to soften a little bit. They're not looking so great. And that's why the 82 went up to 87% right over here. That's why that 18% chance of a Fed hike went down to 13%. Okay. Well, after that, we had wholesale inventories. The number stayed steady. Remember, we talked about this yesterday. Lots of inventories out there, especially in the auto parts. Lots and lots of inventories out there. That reflects poor consumer demand. Well, today we have CPI. Now, here's the question. We guessed yesterday, well, we had high petroleum inventories. Did that mean that the CPI was going to come in a little bit weak today in energy? Well, we actually guessed wrong. It was exactly the opposite. The energy, excluding food and energy, CPI went down. Including food and energy, went up. Fuel, particular. So, what part of this indicates to the Federal Reserve and to us that the Federal Reserve is less likely to raise interest rates? We went from 86 to 90%, 90.5%. We went from 14% down to 9.5% of a hike. 90.5% chance we will not raise interest rates in the next meeting in September. Well, that, I believe, is read from the number that goes down, meaning the inflationary number. The inflation overall went up. The core CPI, excluding food and energy, goes down. See, food and energy, they're very volatile. They're the most volatile components of the CPI. The CPI is a basket of goods and services, cell phones, shoes, eggs, gallon of gasoline, and a lot of other stuff. Well, food and energy are very volatile. They go up and down. Fuel goes up and down for geopolitical events, food, it might be supplies, or, maybe there's a shortage of eggs or whatever it may be. The other products in the basket of goods and services measured by the CPI are less volatile. A cell phone is still a cell phone Monday, Tuesday, and Wednesday. So if we consider it from that point of view, I think the Federal Reserve is more focused on core CPI, which went down. CPI, including food and fuel, went up. Without food and fuel, it went down, which means the cost of everything else, rent, shoes, that sort of thing, that went down. And I think that's evidence that the economy is starting to cool and it's less necessary for the Federal Reserve to raise interest rates further. And again, remember, this comes just on the heels of the non-farm payroll number last Friday. Non-farm payroll was soft. We go up to 87%. CPI, excluding food and fuel, good soft. And then we go up a little bit more. On the probability, again, Federal Reserve will keep interest rates unchanged, 525 to 550. What does this mean for the stock market? That's difficult to say. The stock, now we really have to break this down on a stock to stock, industry to industry basis. Take a look at the stocks in your portfolio and ask yourself, well, do the stocks and the companies that represent the underlying companies, how do they fare in this environment? Let's say we have a softer job market, salaries are down, inflation is cooling down. Are the companies we're investing in resilient? Maybe they have government contracts. Those government contracts don't go away so quickly. Government, suppliers, defense, things like that. But if we're looking at more sensitive luxury goods, handbags, things, very expensive cars, things like that, maybe those are more sensitive. Maybe travel also more sensitive to a softening economy, a poor job market, and less growth. So considered that way, I think it's an impossible question to answer overall because the stock market is such a collection of different companies in different industries and the cross currents that affect those businesses. But I think if you look at it from that point of view, the Federal Reserve interest rate hikes, the most aggressive by far in, I don't know, maybe ever, certainly now, based on the jobs numbers and the CPI, look to be taking effect. And we should adjust our investments accordingly, maybe to be a little bit more defensive in anticipation of a softer economy, at least in the short term. We're going to continue to update our FedWatch tool, and we'll update you along the way with any other significant changes. We do have more inflation numbers coming very soon as well. We hope this has been helpful. We look forward to seeing you back soon.